Hello and welcome back to Chapter 10 Notes, and so we'll resume on the master budget where we left off last. And so now we're going to talk about the schedule of cash disbursements for direct materials. And so what we're saying here is that our vendors extend us credit. So basically we can buy things on the buy our materials on the corporate headquarters, and then we can pay them off later during the month or maybe even the next month. So what we're saying here is we have a few assumptions. We say half of the month's purchases are paid for in the month of purchase. The other half are paid for in the next month. There's no discounts given for early payment. In the accounts payable balance at the end of the first quarter, March 31st, end of the first quarter, was $12,000. And of course, that is our beginning accounts payable for quarter two. Okay? So looking over here of our schedule for cash disbursements, we say, I'll say quarter two. Remember we had $12,000 that's given to us. And then we look at April purchases. So in order to get how much we're going to purchase, we have to look back over here at our direct materials budget. It says we're going to spend $56,000 in April. We say half the month's purchases are paid for the month of purchase. The other half is paid for the next month. So we will pay half of April purchases in April. The other half we will pay in May. So we come over here. 56,000 times the 0.5 gives us the 28,000. We add the two together, that gives us the 40,000. And then April purchases paid for in May is 28,000. May purchases paid in May is half of the 88,600 for 44,300. Okay, add the two, you get the 72,300. 44,300. And then June purchases paid in June is half of the 56,800. Which is our 28,400. When we add down, we get our $72,700. We can add across to get our total for quarter two, 185. Now, the journal entry that we're talking about over here, right, to purchase these raw materials, is when we buy them, we would debit raw materials and we would credit accounts payable. And then when we pay this off, we would debit accounts payable and credit cash. Okay? So at the end of April, what would be the outstanding accounts payable balance? Of course, that would show up on the balance sheet under current liabilities. What would be the outstanding accounts payable balance at the end of April? Well, it's $28,000. This is how much cash we paid. But remember, we paid for half of it now, half of it later. The half of it later that we pay in May is the ending AP balance, accounts payable AP balance at the end of April. With June, what would be the accounts payable balance at the end of June? Well, it's half of June purchases, so it's the $28,400. Remember, this $28,400 would come over in July as well. We would pay half in June, half in July. So the ending accounts payable for June is $28,400. Now, the ending accounts payable for June is the same as the ending accounts payable for quarter two, because balance sheet shows a point in time. So it's like I took a picture at the end of the quarter, figure out the accounts payable balance, and it's $28,400. The $28,400 is also the accounts payable balance at the end of the quarter as it is for the end of June. Okay? So now continuing on with our direct labor budget, our direct labor shows how much we're going to have to pay for direct labor. Now, in order to do this, we need to know how long it takes us to make one unit, and then how much each hour of direct labor costs. Okay, so we look over here. We say units to produce. We would get this from the production budget. So if you look back at April, and you said, well, how many units are we going to make in April? If you look back at the production budget, let's say 26,000 units. Each unit requires 0.05 hours to make. Okay? And then we multiply it to get our 1,300. Right? And then we'd say our direct cost, and it says that each hour of labor costs $10. $13,000 is going to be our labor cost for April. We can do the same thing for May. We look back at the production budget and make 46,000 units. And for June, you look back at the budget, it says 29,000. We can sum it across to get the total for the quarter. And you multiply it out, you get 2,300 here, and then you get your 1,480, and then you get your 5,050, and then you multiply it times 10 across the board, right, to get the total for direct labor, which is going to give us our 23,000 here, our 14,800 here, and then our 50,500 there. That's our labor cost. These are the hours. This is the labor cost. Okay. Now we can look at the next budget. This is our manufacturing overhead budget. So our manufacturing overhead is going to separate out manufacturing overhead into fixed and variable components. Okay. So fixed is going to be a certain amount per month. Variable is going to be a certain amount per labor hour. Okay. And so we apply manufacturing overhead on the basis of labor hours. And so that's why we do it per labor hour. Okay. So you look over here, so fixed overhead is $50,500 per month. That includes $20,500 in depreciation. Now, the reason that we want to know that is because we look on the next page to do our manufacturing overhead budget. You can see here's our total overhead, but then here's how much cash we pay for our overhead. So remember the journal entry to record depreciation is debit depreciation expense, credit accumulated depreciation. In that journal entry, there's no debit or credit at all to cash. It's a non-cash expense. So it does show up on the income statement, but it's a non-cash expense. So to get the cash disbursements right, we have to subtract it out of the total to get to the cash disbursements. Okay? So we'll look over here and it says our budgeted direct labor hours, and the reason that we have that up here is because we have our variable overhead is per labor hour. So the way I would get my budgeted labor hours is looking back at my direct labor budget. 1,300 hours, 2,300 hours, 1,480, 5,050 hours total. Okay? So I'm going to pull that in here. 1,300 hours for April. And then May was 2,300 hours, 1,480, 5,050. And then on the prior page it says variable overhead is $20 per hour. You multiply them, you get your total variable overhead, 26,000, 46,000, 29,000, 101,000. We add in our fixed overhead of 50,500 per month. Okay. And then that gives us our 151,500 for the total quarter. Okay. And then we can add to get our total manufacturing overhead, 76,500. And just adding down, we get our 96,500, our 79,500. Then we can add across to get the total overhead of our 252,500. And then again, we subtract out our depreciation because depreciation is not a cash expense. And we want to know our cash disbursements. How much do we actually have to pay in cash for our overhead? And the reason that we want to know that is because we will eventually do the cash budget where we're going to need to pull that in. Okay. So I'm going to subtract out my depreciation, 20,500 for each month, which gives us our 61,500. And then we get our cash disbursements here, $56,000. $76,000, $59,000, and then $191. Okay? Those are our totals. Now what I want to do is I want to talk about calculating the dollar value of our ending inventory. So remember, our ending inventory is going to show up in the current assets section of our balance sheet, and we want to go ahead and calculate that out to figure out what do we expect the value of our ending inventory to be. Okay, so in order to do that, what we're going to do is we're going to calculate the cost for making a single unit. Okay, what's the cost for making a single unit? Okay, now it says over here, Royal Company uses absorption costing. That means, remember, from Chapter 5, it means that they push fixed manufacturing overhead down to the unit level. They include fixed manufacturing overhead in cost of goods sold. If you use variable costing, you would treat fixed manufacturing overhead as a period cost. Okay? Manufacturing overhead is applied on the basis of direct labor hours, and the company has no work in process inventory. Okay? So continuing on with our next page right over here, we can go ahead and calculate that. If you look back at our direct materials budget, you would see that each unit requires 5 lbs, 5 pounds of material to make a single unit. So again, what we're going to do is we're going to try to calculate out our unit cost. Our cost per unit is 40 cents per pound, which means the total cost of materials per unit is $2. Okay? Our direct labor is 0.05 hours to make a single unit, and the cost per hour is $10 per hour. So the labor cost that goes involved in making a single unit is 10 times the 0.05, okay, or 50 cents. Our manufacturing overhead, remember, is applied on the basis of direct labor hours. So what I'm going to do is I'm going to take my manufacturing overhead, okay, and I'm going to apply it to each unit. So that means I have to first calculate my manufacturing overhead rate. Remember that? We calculate our manufacturing overhead rate, and then the rate times the amount of allocation base used is how much is applied. So we come over here, we take our manufacturing overhead. Now if you look back at the manufacturing overhead budget that we just did, you would see that the total manufacturing overhead is equal to our $252,500. So that's from the manufacturing overhead budget that we just did. I have to include depreciation in this number because I will push depreciation down to the unit cost. So I don't want to just use the cash disbursements. I want to use total overhead. Now it says on the prior page, it said that we applied overhead on the basis of direct labor hours. So what you would do is you'd look back at our direct labor budget and see that we thought we were going to have 5,050 hours. That's total hours. Okay? And when we do it, we get $50 per hour. Okay? So then how many hours does each unit use? 0.05 hours. We multiply that times our $50 per hour, and then that gives us our $2.50. Okay? $2.50 of overhead for every unit that we make. Okay? So I can come over here and I can add these up, and I'm going to get $5 is my unit cost. Okay? Now if you look back at the production budget, okay, let me see if I can't find that. Here we go. If I look back at my production budget, what is my ending inventory for the quarter? Well, my ending inventory for the quarter is 5,000 because the end of the quarter is the end of June. So I think I'm going to have 5,000 units in ending inventory at the end of the quarter. 5,000 units. And then my unit product cost is $5. That's right up here. That means the value of my ending inventory is $25,000. Okay? I'm going to end this lecture video here. The next one will continue on with the budget, the subsequent budgets. Okay? Thank you.